Ready? I'd like to introduce our next presentation here at the Planet MicroCap Showcase Toronto in partnership with MicroCapClub. Joining us right now is Chris Dobbin from Nova Leap Health.
Thanks, Bobby. Thanks very much for everybody for attending the presentation today. I'm going to do this in probably three parts. One is I'll give you a bit of a high-level overview very quickly in terms of how far we've come over the last few years. The second is I'll actually walk you through the deck, but just touch upon the high points. And then the last part, I'll kind of try to answer the question, what's in it for me from an investor perspective? And I think I've got some key points here that I think you'd be interested in. And then I'll finish that with, what management is trying to accomplish over the next little bit, and then sort of give you an example and some actual numbers to sort of work with. And then you can kind of determine whether or not you think we can achieve what we're trying to achieve. So my name is Chris Dobbin. I'm the founder of Nova Leap Health Corp. I'm joined by our CFO, Chris LeBlanc, actually here, if you guys want to meet him later on, particularly if you're coming up for any of the one-on-ones. So founded this company about 9 years ago. Matter of fact, I think in five days' time, we will have been in operations for 9 years. Okay. Based out of Halifax, Nova Scotia, traded on TSX-V, and we are in the senior care space. In particular, we're in the in-home senior care space, meaning that we go into an individual's home and we provide home care, particularly those living with dementia. When I started the business, and again, we're almost 9 years into it now. In our first 12 months of operations, so first year of operations, we were running, actually we did 5,350 hours of service. Okay, so when we go into a person's home, we provide an hourly service. So just over 5,000 hours of service in the first 12 months of operations. In the next 12 months, we should exceed 1 million hours. So over 9 years, we've gone from 5,000 hours of service to about 1 million. So it's been fairly substantial. We've gone from our first employee back in 2016 to over 1,000 employees now across 2 countries. We have about 700 employees in the US, about 300 in Canada. We operate across 9 states in the US. So that's at a very, very high level, just how far we've come over the last 9 years. So what do we do? I mentioned that we're in the in-home care space. So you think about mom or dad or a loved one that has a safety issue at home, they have dementia, they're coming out for hip or knee surgery. We typically go in and we do an in-home assessment, and then we send a caregiver in to provide one-on-one care with that individual. So in my case, I started this business because my father-in-law was diagnosed with Parkinson's many, many years ago. And we saw him deteriorate over a period of a number of years. We didn't have an experience with home care. We learned about home care. We ended up getting home care for him and my mother-in-law because she needed a break, very difficult circumstances. And so that's quite honestly how we learned about home care. And it was a really good experience for us. What we learned is that there's probably a little bit more training that goes along when you provide service to somebody who has dementia. And so ever since that time, we've taken a personal experience. We've been making some acquisitions over these 2 countries. So the home care industry as general, I think everybody understands the demographics. We have an aging population. Everybody's heard the concept of the baby boomers. So this is really what it's about. You have people that are achieving the age of 65, and when they turn 65, they have a high probability of having at least one chronic or long-term condition. And so it's the health-related conditions that are leading to the need for care in the home, and that's what we provide. So I think everybody's seen the stats that, we will have, and we have an aging demographic for the next 4 decades. So there's a 40-year runway here before before you reach the peak of aging, if you will. So long runway in terms of, what's achievable within this industry. We operate in 2 countries. So within Canada, we're in the province of Nova Scotia. We have a number of offices throughout New England. We're as far south as Florida. We're as far west as Dallas-Fort Worth area, and a number of areas in between, including Cincinnati, Ohio, Louisville, Kentucky, and so on. So We're pretty spread out, but have a great team of people that run those operations. So we have been acquiring companies, I would say on average 3 to 4 a year for the last several years since we started making acquisitions at the tail end of 2016. And what we're typically looking for is a business that's been around 10 or 15 years, historically profitable, and there's probably 3 or 4 people in the office. And one of them, and these are generally succession planning opportunities. So you have someone that started a business 10 or 15 years ago, they're tired, they have a health issue, they're looking for an exit, and that's where we come in. So we're usually paying between 3 to 5 times EBITDA pretty consistently. If you go back through all our press releases, all our deals are very, very consistent. The manner in which we structure our deals is very, very consistent. So all that information is available. But these are, the definition of mom and pop businesses. I mean, they are businesses that are maybe on the low end, 800,000 of revenue. On the high end, I think maybe 3.5, maybe 4 million, 3.5 million, probably the biggest one we've done. And so we're often buying businesses that are, $1.8 million of revenue, $2 million, 2.2. So again, very, very consistent. We do that on purpose because we're still, even though we're a fast growing company, we're still a very small organization as a publicly traded company. And M&A in itself has inherent risk. And so we buy these small businesses. If one of them doesn't go as well, we're not happy, but it doesn't stop our strategy. It doesn't slow us down. If we were to take on a huge chunk that represented 25% of our business and that didn't go as well, then I think that would set us back a couple of years. So, we like these small mom and pop businesses and they're additive to us over time. There's 3 ways that we're really looking at growing. This will probably change a little bit in the coming year, but organic growth. So to give an example of that, we just opened a brand new office in Lexington, Kentucky. So we have a great business in Louisville. And so we wanted to expand throughout the state of Kentucky. So we opened an office in Lexington. So just a startup location, example of organic growth. Acquisitions, we've done probably north of 20 acquisitions now over the last 9 years, and we'll continue to make acquisitions. We've made 3 acquisitions over the course of the last 10 or 11 months. So we entered Florida last December for the first time, and we made 2 acquisitions in Nova Scotia, one in January and one in May. So we've made 3 acquisitions over the last about 11 months. All right, I'm going to take you through our financial profile just to see, and I'll highlight, I think, a few key areas here. And this will be important because I'll circle back to this at the very end. Again, on the far left, top left is our annual revenue. So again, we started this 2016. I think we had $40,000 US revenue. We grew that to 25 million last year. You'll see on the far right that we're trending north of 32 million, and that's US, by the way, that's US dollars. So at today's exchange rate of $1.40, we are trending over $45 million Canadian. Okay, so just put that in context. I think a lot of people forget that we actually report in US dollars. And really we've sort of set a new bar here. Q2 were record results for us. We set a number of records, really across the board. And so we've sort of set a new base for us going forward. And this is a result of the acquisitions and the investments we've made into the businesses. On a quarterly adjusted EBITDA perspective, you'll see from the bottom right-hand chart, going left to right, again, we have sort of set, for the, I'd say 2.5 years, we were running pretty consistently at about $400,000 US of EBITDA. And, we've really set a new bar here with our record results in Q2. So we had 577 US EBITDA. So we're running pretty close to $600,000. We'll have Q3 results, I think, out on November the 6th. I just want to spend a little bit of time on a quarterly revenue chart for a second, just to give everybody some context. So COVID hit in 2020. We were still kind of ramping up a little bit, but we did get hit during COVID, and that set us back a little bit. But what we did do is we focused very much on operations, and for the last really 3 years, on a quarterly basis, we generate positive operating income. So you can go back every quarter for the last 3 years and know that we generate operating income. So, we take that income and that cash flow, and we either make an investment by way of M&A, or we put it into our existing businesses, or we'll pay down debt if we have acquisition related debt. But we are a cash flow positive business. Every single quarter, we generate cash, and then we make a decision what to do with that cash. So again, I think it's critical to understand that, we were ramping up very, very quickly from 2016 to 2019. We took a hit during COVID for a couple of years. We came out of COVID, actually the best financial shape that we've ever been in, which is our current position. And as a result, we've been generating quarterly cash flow for 3 years in a row, and have limited debt. Management team, board of directors, there's 6 of us on the board, 5 of who are independent, combination of public company experience, entrepreneurial experience, executive experience, and we love our CPAs. And the corporate cap table, about 87 million shares outstanding, 42.5% insider ownership. So pretty tightly held. So I want to come back to just a few notes I made that I think will be important to sort of tie this together, and then sort of take you through really what we're trying to achieve based on where we are right now and where I think we're headed. So one is we generate consistent cash. So like I said, every quarter, and we've been doing this for the last 3 years, we generate positive cash flow. 2, we have not done any private placements for 3 years. So tying back to mid 2022, when we started to generate positive cash flow on a quarterly basis, we have not had a need for new equity issuances. And we have 42.5% insider ownership. 3, we have about $4.6 million US left of debt with our bank, which is part of a $7 million US facility that we announced at the end of 2024. Okay, so there's still about $4.6 million US left of debt that we can utilize towards acquisitions. And I'll come back to that in terms of why that's critical for us. I talked about the 42.5% insider ownership. We have endless possibilities to grow our business by way of acquisition and expansion. I've said this and I still believe it. I'm not sure we can run out of M&A opportunities during my lifetime. There's an aging population. The aging population owns home care businesses. They need an exit strategy. We are one potential purchaser as part of that exit strategy. There are the operating leverage that, and I think this is critical, we are starting to show that operating leverage, and I'll talk about that in more detail. So in Q1 of this year, we were at a consolidated EBITDA of 4%. Last quarter, Q2, we were 7.1 or 7.2%. We expect that that'll continue. So I've said numerous times that when we get $40 million of revenue, that we should be very close to 10% consolidated EBITDA. So I think it's in probably that 9 to 10% consolidated EBITDA range. So again, Q2, we were 7.1 or 7.2. So we got another 3% from 7 to 10 to move up there. And so the question is, how do we do that? So if we're currently running, call it $32 million of revenue, and we have $4.6 million of debt, and we utilize that $4.6 million of debt towards acquisitions. We normally acquire major acquisitions. They usually translate to about 0.6 times of revenue. So if we take the 4.6 million of debt, divide that by 0.6, I think that's probably 7 point some odd million dollars of revenue that we could acquire. Our agencies are running at about 16.4% of EBITDA margin. Okay, so that's what an agency runs on average. So if we take the revenue we can acquire and apply that consistent average that we're getting right now with our agencies, that should translate into about another $1.25 million of EBITDA. We're currently trending at roughly 2.4. So management sees a path with the current debt facility in place to grow EBITDA by 50% without dilution. Those are rough numbers. Now, will we have to add some new folks as part of the team that, you know, may not be part of the agencies? Yes. So that it won't be exact, but there's a path, we believe, to increase EBITDA by roughly 50% with our current debt facility. Okay, without dilution. And I think that's critical for investors to understand what we're trying to achieve. Now, the question for investors is, you know, do investors believe that management can achieve that? Right? That's a fair question. And I think that's one that you have to sort of, you know, think about, right? But that's what we're trying to achieve. We're right now running around 2.4 million US of EBITDA. We have 4.6 million of debt. We have purchased all of our companies very consistently. And that translates, we believe, to roughly an opportunity to expand our current business by roughly 50%, our adjusted EBITDA by about 50%. So that is what we are trying to achieve as a management team from a purely financial perspective. Okay, so I've laid that out as best as I can in terms of where we're trying to head. People have to make their own assumptions of whether or not they believe we can do it. I think it's possible, and that's our goal. So I'll stop there and be happy to take any questions. Yeah, go ahead. Yeah, so the question is like the Medicare and Medicaid cuts that are impacting a lot of businesses in the US, you know, what impact will they have on our business? So I think it's important to understand our business, we're a private pay. So there's really three ways in which we generate income. One is out of pocket by the clients we provide service to or their adult children, right? So that's the private pay aspect. There's veteran affairs, so the VA, or there's long-term care insurance. So the impact of, you know, the cuts that happen in Medicare and Medicaid, and that's an annual, you know, thing that those companies have to go through. It's really not, it doesn't touch us from that perspective. So when the Medicaid cuts happen or Medicare cuts happen, it doesn't have a direct impact on our business. So no, there would be no pivoting of our business whatsoever. All right. Trevor?
Obviously, you've developed a good track record. Oh. On the M&A side, you obviously developed a good track record with integration. Realizing that it's a lot of mom and pop shops, are there any acquisition targets that would be more significant in size that could add some significant scale?
Yeah, absolutely. Look, I get this question a lot. The question being, you know, can Nova Leap acquire much larger businesses than what it's acquired historically? And the answer is absolutely. Yeah, I mean, we could acquire businesses that are larger than us. We could do that, but we're not gonna. We don't think that's the right thing to do at this point in time. We certainly don't think we're fairly valued from where we are today. We think the risk is too great to take on that big of a bite at this point in time in our evolution. And so where we think we get the biggest return is continuing to acquire these small mom and pop businesses. And it may not be exciting for a lot of people. It is for us because we know the types of returns they generate. And so that's the path that we'll continue on. Now, at some point down the road, will we acquire small, you know, larger businesses? Yeah, I think so. But we're so good at acquiring the ones that sort of fit our profile right now that I just think when you're good at something, you stick to it. And so that's kind of the path that we're on. Right.
What's your weighted average cost of capital, and how does that compare with your return on invested capital?
So question is, what's our weighted average cost of capital? You know, it depends on what you think our cost of equity is, I suppose, in one way, right? I don't know how to answer that question other than, the returns that we're typically looking for are at least 20% because we're buying at 5 times. I mean, I can estimate and say, our debt is around, depending on the US, 8 or 9%. And that's all we're employing right now. We're not really raising equity. So it depends. I think there's a bit of a philosophical debate to have in that type of a question. Some people will assign 8% for the cost of equity. Some people will assign 20. It really depends on what your viewpoint is. So it's a long-winded answer to say, I don't know. I've had the debate so many times the last decade that it depends on how you view it. Yeah.
2 questions. So one is regarding the synergy, right? Or integration of after your acquisition. And second one is regarding your expansion. So why you choose to expand south instead of going like across Canada first?
Yeah. So maybe I'll answer that in reverse. So the second part of the question was why have we chose to expand down south versus, more in Canada? We actually have in Canada expanded quite significantly this year. We've made the 2 acquisitions, both in Nova Scotia, and we think there's more expansion opportunities within the province of Nova Scotia. And I think once we satisfy ourselves that we sort of have saturated that market, then we'll start to expand east, or I guess west, sorry, but more within Atlantic Canada and potentially in Ontario. We're just not at that point yet. In terms of expansion within the south, our viewpoint is that we want to go deeper in the regions where we already are, because we're getting common management, common brand, just a bigger impact on referral sources. And what we've seen is that the more locations we have in a particular province in Nova Scotia or in a particular state, like say Massachusetts, the better off we are. And so really our plan is to continue expanding in the areas where we already are. We're not really looking to expand at this point outside of the states, or at least a very tight geography where we currently operate. In terms of synergies, yeah, look, there are some synergies, but that's not why we do M&A. That's not why we wouldn't do a deal if we only thought it was just synergistic. Because I think you have to be very careful with that, because my viewpoint on M&A is a lot of synergies that people sort of build into their models don't actually pan out. We have shared services around accounting and billing and payroll and HR and IT and the things that you would expect as a growing organization would. And so, yes, there are some things we can do when we add a new agency. We would share an account across that agency with a couple other agencies. So there are some synergies that we would get. And that is one of the reasons why we like expanding in the areas where we already are. So the employment law, for example, in Massachusetts is different than the employment law in Texas. So somebody has to understand that, right? So it makes sense that we would continue to expand those states versus, say California, which is different. So just a few minor examples, but yes, there are some synergies. I don't look at that as being a reason to do M&A. And again, back to the other part of your question, we'll continue to expand in the areas where we already are, because our experience has been that's where we're most successful.
Problems with hiring and retaining employees in the past. How's the job market for you right now? Are you able to get the amount of employees you want and work in the amount of hours you want?
Yeah, I think on the hiring side, I think this is why it's really important to understand, the impact that COVID had in our business. I mean, that was the most challenging time we've ever had to hire people, like without question. And, today's environment is so different than what it was, 3 or 4 years ago. It just is. I mean, the messaging that was coming up from all of our agencies back in 2021 and 2022 was just how difficult it was to get caregivers. And that's really not the messaging that's coming up now. It's just a different discussion. So, we'll always be challenged to hire caregivers, because that's just the nature of our industry. We're trying to match them up with the family. We're trying to get them the hours that they want. Their skill set has to match up with the profile of our clients. So the whole thing's, that's just an HR complement that happens on a daily basis. But the hiring environment for caregivers today is vastly better than what it was 3 or 4 years ago, for sure. Yeah. And look, it's translating to the results. I mean, it's clear. Yeah. Yeah. Other questions? I wish we could start with Q&A and just skip the presentation. My favorite part. I like the Q&A. Go ahead.
Are you acquiring facilities that require a lot of Medicare and Medicaid and converting to private pay at all?
So I just want to be careful with the word facility because we don't acquire facilities. This is in-home care. So we acquire an operation and our caregivers go into a home or they go into someone else's facility for one-on-one. So I just in case there's any distinguishment that has to happen there. And the answer to the question is no. We do not acquire companies that are providing Medicare and Medicaid and then convert them to private pay. No. Those businesses are so different. And the administrative nightmare you'd have to go through to get certified, to be able to go through a change of ownership to then convert to something that you don't even need is just not, it's not worth it. Pardon me? Is it helping to clear out the competition? Yeah, I don't know. I don't know. Look, there's a lot of this is a competitive industry. Like this, nobody should fool themselves. Like it's competitive industry, but that's fine. I mean, like, I think you have to put in a context how much demand exists for home care. The biggest part of the market is not Medicare or Medicaid or private pay. It is unpaid family caregivers, and it's not even close. The impact that on families, right, is significant. And I'm not sure people realize how significant it is unless you've been through the circumstance. It is a real issue. And so we play one small, very small part in that, major societal problem that exists right now is how to provide support to families that are doing it all themselves. Other question? No. All right. Thanks very much for coming. Really appreciate it.